Welcome you all to the Accounting Part of YouTube channel. So in our last video we discussed about the preparation of cash flow statements with a past paper question. So today we are going to discuss about the accounting ratio. So it will be a very simple lesson and it will be very important beyond your A-level examination. So most of the students are going wrong at the A-level examination even though this lesson is very simple. When it comes to your accounting paper, for the second paper there will be a question up to 5 marks. So when it comes to the first paper there will be questions, 2 to 3 questions. So approximately you will be able to cover up around 10 marks using this simple lesson at the examination. Before moving on to the accounting ratios, you want to understand the purpose of preparing financial statements. So as you already know, the purpose of preparing financial statement is what? It's to provide financial information to your stakeholders, to the intended parties about the business. So as financial statements, you provide them with income statement or the balance sheet. Those things now in your balance sheet or the income statement, there may be just rough figures. So for the users, just looking at those figures, can they take decisions regarding the company? No, right? As an example, let's take gross profit. So when it comes to the last year, it may be around 15%. So this year, it is around 10%. So the reduction in your gross profit. So then you can take decisions. So what are the impacting factors to the gross profit? That's revenue or the cost of sales. So then you can decide whether your cost of sales has been increased. Okay, so your supplier's cost is much higher. So you have to move on to low cost suppliers in order to gain a higher profit than the last year. So those strategic decisions can be taken using these accounting ratios. So when it comes to your A-level syllabus, these are the main 4 categories of accounting ratios. So the most important thing is you won't be provided the accounting ratios at the examination, so you have to by heart those things. So it will be very simple, and there may be around 15 to 20 ratios that you have to by heart. So profitability, using the profitability ratios, we measure the company's profitability. So we can compare the last year profitability and this year profitability, and we can compare X company profitability with B company profitability. So likewise, and then liquidity. So using liquidity ratio, we measure the company's ability to repay its debts on time without incurring any extra cost. So activity. So using activity ratios, we measure the operational efficiency of the company. And gearing ratio. So using gearing ratio, we measure the relationship between debts and the equity within the company. When it comes to the profitability, the first ratio is gross profit. So it can be calculated using gross profit divided by sales into 100. So the both gross profit and the sales, you can extract it from the income statement. So by using this gross profit ratio, you will be able to identify whether your gross profitability is much higher or it is lower. So then you can take strategic decisions like what I mentioned earlier. So then you can check whether the supplier cost is much higher than the other company's supplier cost. So then you have to move on to lower cost suppliers. So the raw materials that you are using will be much higher. So then you can move on to another low cost raw materials. So those decisions can be taken using gross profitability. And the second ratio is net profit. So it can be calculated using net profit divided by sales into 100. So by calculating net profitability, you can compare whether your company's net profit is much lower or higher than the other companies. So if it is lower, you can decide to reduce the cost like advertising expenses and entertainment expenses. So those decisions you can take by analyzing the net profitability. So those two ratios will be tested very frequently at the examination. And the third one is ROE, that is return on equity. It will be calculated using profit after tax divided by equity into 100. So the profit after tax is the net profit. So what is equity? Equity is the equity holders funds. So shareholders, I mean the value of ordinary shares plus reserves. So those two things will be the equity. So when it comes to reserves, all the reserves, revaluation reserve, retained earnings, general reserve, those things should be there. Fourth one is return on capital employed, ROCE. So profit after tax plus interest divided by capital employed into 100. So profit after tax is the net profit and plus interest. Capital employed. So what do you mean by this capital employed? This capital employed in the sense, when it comes to a company, the capital can be collected in two ways. That is debt holders funds and the equity holders funds. So the term capital represents both equity holders and debt holders funds. So profit after tax plus interest. Why do you add that interest again? When it comes to the capital employed, it represents both equity holders and the debt holders. So their total return should be represented in this ratio. So when it comes to the profit after tax, interest is excluding. That means interest has been deducted. So therefore, profit after tax represents only the equity holders funds. The interest is the return for the debt holders. No? So interest has been deducted in the sense it represents only the return to the ordinary shareholders. So we have to add it back in order to calculate the total return for the capital employed. And fifth one, so return on assets, ROA, profit after tax plus interest divided by total assets into 100. So like the ROCE, return on capital employed, we have to use the profit after tax plus interest divided by total assets. So those things you can extract from the income statement and the balance sheet. So profit after tax and interest will be given in the income statement, and total assets you can be extract from the balance sheet. So that's the non-current assets plus current assets. So all these ratios should be multiplied by 100. That means you have to represent these ratios as a percentage. And the next ratio type is liquidity. So what do you mean by the liquidity? So liquidity is the company's ability to settle its short-term debts, short-term loans or whatever short-term liabilities without incurring any extra cost. So we can measure the liquidity position of the company using two ratios, basically two ratios. So the first one is current ratio. Current assets is to current liability. So the current assets is the total current assets position of your balance sheet, and the current liability is the total current liability position of your balance sheet. So the benchmark is 2:1. So what do you mean by this current ratio? So the current ratio represents the company's ability to settle one current liability using their current assets. So obviously it should be greater than 1, otherwise there will be working capital issues. So the benchmark is 2:1. If it is greater than 2, that's okay, but if it is less than 2, so the company should try to increase their current assets position in order to settle their current obligations, current liabilities without incurring any cost. And second one, quick ratio. So it can be calculated using current assets minus inventory is to current liability. So why do you deduct inventory here? So the word quick represents the most quick assets in your balance sheet, which will be able to convert into cash very quickly, right? So inventory you cannot convert into cash very quickly. So like debtors, you can call debtors or you can request debtors to pay money. So cash in hand anyway cash, but inventory you cannot convert into cash like that. So you deduct that from total current asset. So the benchmark is 1:1. So the next type of ratios is activity ratios. So the first one is inventory turnover ratio. So it can be calculated using cost of sales divided by average inventory. So cost of sales you can extract from the income statement. Average inventory is the opening inventory position plus closing inventory divided by 2. What do you mean by this? Inventory turnover. That's how frequently your inventory getting converted into your revenue, right? And next one is inventory holding period. So previous one will be presented as a term and this will be presented as a day. So average inventory, that's the opening inventory plus closing inventory divided by 2, should be divided by cost of sales into 365 days. So the answer will be presented as a day. So there will be another alternative formula, 365 days divided by inventory turnover ratio. So that's the answer for the previous ratio. So by using this inventory holding period, you can check whether your inventory holding days are higher. So that will be harmful to your stock. So you have to reduce the level of inventory that you are keeping within the company. So those decisions you can take. And the third ratio is debtors turnover ratio. So it can be calculated credit sales divided by average debtor. So sales you can extract from the income statement, but credit sales will not be presented there. So at the examination they might provide you the level of the percentage of credit sales that the company is having. So then using that you have to identify the credit sales. So it should be divided by credit average debtors. So that is the opening debtors plus closing debtors divided by 2. So debtors turnover ratio represents the how far your debtors are converting into sales. And the second one is debtors collection period. So that represents the collection days. So how long you are taking to collect your receivables from debtors. So that is average debtors divided by credit sales into 365 days. Answer would be a number of days. And there will be another alternative formula. So that's 365 days divided by debtors turnover ratio. So that's the previous ratio answer. So next one is creditors settlement period. So that's the number of days that you take to settle your outstanding creditors. So by using this ratio, you can negotiate with your suppliers to increase the credit period. So you can manage your working capital position by analyzing this ratio. And next one is assets turnover ratio. So it represents the your sales position compared to the assets. So the sales divided by total assets. And fixed assets turnover ratio represent the your sales when compared with the fixed assets. So sales divided by fixed assets. And the next type of ratios is gearing ratios, and it will be very important. The first one is debt to equity ratio. So it can be calculated using equity into debts. Equity is to debts. So debts is the long term debts. So that means whatever the non-current liabilities in your financial position. And equity. So equity is the ordinary shareholders funds plus reserves. So that means the ordinary share capital plus reserves. So it represents the relationship between the ordinary shareholders funds and the debts within the company. And second one, debt ratio. So it represents your debt position within the company. So as at the date, as at the financial year end date, how much of debts as a percentage, how much of debts that you are having as at that date. So debts divided by invested capital. So earlier also we discussed invested capital is the total debts plus long-term debts plus shareholders funds and reserves. So it will be presented as a percentage. So by using that you can analyze your company's gearing position. So as an example, let's say your gearing position, your debt ratio is more than 50%. So that means your debt ratio is higher. So your debt position is much higher. So if you have much higher debts, you have to pay interest, not like equity. You have to pay interest. So your profitability comes down. So if your debt position is much higher, it's not suitable for your company to finance further debts. And next one, equity ratio. So it's the equity divided by invested capital into 100. So that's the other side of debt ratio. So equity is the shareholders funds plus reserves divided by invested capital is the debt plus equity into 100. And the interest cover ratio, so it's a very important ratio. So it can be calculated using profit before interest and tax divided by interest. So it measures how far your interest expense has been able to earn profits. So that on the other side, how your profit has been, how many times your profit has been able to cover up your interest expense, right? So for that you have to take profit before interest and tax. So if you check the income statement, you won't be able to find a name like profit before interest and tax, but you can find profit after tax or profit before tax. So go reverse. So if you have the profit before tax plus interest expense. So if you have the profit after tax, add income tax and interest expense. Should be divided by interest. So that's all about the accounting ratios. So as you can see, there are up to 15 to 20 accounting ratios. So the most important thing is you won't be provided these ratios at the exam. So you have to by heart those things, right? So you have to practice before the examination using these ratios. And very important thing, write the formula at the exam working paper, right? Let's check the 2017 past paper question. So what they have tested from this lesson. So if we check the 2017 A-level paper, there will be a question from this lesson. So question number 5A. So I will read the question for you. The following information relates to Mangala PLC for the year ending 31st March 2017. So sales 6,300, profit after tax for the year is given, interest expense, tax for the year. A summary of your income statement is given. And as at 31st March 2017, a summary of your balance sheet. So total assets represent property, plant and equipment, inventory, trade receivable, cash. So let's assume that's all about the total assets. And total liabilities represent trade payables and bank loan. Bank loan payable after 3 years. So it indirectly says that's a long-term liability. And under additional information, first one, trade receivables as at 31st March 2016. So that's the previous year ending balance. So it should be the opening balance of our current financial year was 600,000. All sales were made on credit basis. So if you check your sales in the income statement, that's 6,300. So that the whole 6,300 was sold on credit basis. It's required for the year ending 31st March 2017. You have to calculate 5 ratios and 5 marks are allowed. So the first one is current ratio. So you know the current ratio can be calculated by current asset is to current liability. So the most important thing is at the exam you have to write the formula, right? So then only the examiner knows that you know the formula. So the current assets, so we have to extract the current assets from the balance sheet. So if we go through the balance sheet, current assets are the inventory, trade receivables and cash. So the total is 500, 800 and 200. So altogether 1500. And the current liability represents only the trade payable. So it's 500. So the ratio is 3 times. So your answer should be like this. And the next one is debtors turnover ratio. So you have to calculate debtors turnover ratio using credit sales divided by average debtors. So credit sales, the credit sales is not given, but under additional information there was a clause, all the sales were made on credit basis. So all the 6,300 sales were made on credit basis. And average debtors, so we have to get the debtors average balance. So that means the opening debtors balance plus the closing debtors should be divided by 2. So the opening balance was given as an additional information, that's 600, and as per the balance sheet the closing balance is 800, so should be divided by 2. So average balance is 700, so your answer should be 9 times. And the next ratio is return on equity. So ROE should be calculated using profit after tax divided by equity into 100. So the profit after tax was given, so that's 1200, but equity balance was not given. But you know the difference between total assets and the total liability is the equity. So the total assets you can get the summation of your asset position and get the summation of your liability position. So the difference is your equity. So as per this question, it's 3000. So multiply it by 100 and your answer should be 40%. And the next ratio is interest cover ratio. So profit before interest and tax divided by interest expense. So in this question, profit before tax and interest is not given. Only the profit after tax is given. So that's 1200. So as we discussed earlier, if you want to go to profit before interest and tax, you have to add the interest and income taxes to the profit after tax. So tax is 600 and the interest expense is 300 and should be divided by 300. So the answer is 7 times. And the last ratio is assets turnover ratio. So sales divided by total assets. So the sales balance is given 6,300 and the total assets is the summation of assets side. So that's 4,500. So the answer is 1.4 times. So that's all about the second paper. So as you can see, it's really easy to find 5 marks from this lesson. So it won't take much time as well. So just 3 or 4 minutes is enough for you to finish off the whole question. So now let's check what they have tested for the MCQ paper and the fill in the blanks questions as well. If you check the 22nd question in your MCQ paper, the following information relates to a manufacturing company. As at 31st March 2017, current ratio 2:1, current liabilities 300, inventory 120. For the year ending 31st March 2017, sales 600, gross profit margin 25%. So inventory as at 1st April 2016, so that's the opening balance, was 180. What is the quick ratio and the inventory turnover ratio of the company? So there are two ratios to be calculated using the given information. So let's calculate using the given information. How do you calculate the quick ratio? So that's the current assets minus inventory divided by current liabilities. So here, can you find current assets? The current assets is not given, it's not provided, but only the current ratio is provided. So you have to know what is current ratio. So how do you calculate the current ratio? That's the current assets divided by current liability, and that's 2:1, and current liabilities is 300, and current assets are not given. So if we build up a relationship between the current liabilities and current ratio, if current liabilities are 1, current assets are 2. So according to this question, current liabilities is 300. So obviously then current assets should be 600. So if current assets is 600, you have to remove the inventory balance from 600. So the inventory balance is 120. So your quick assets are 480. So to calculate quick asset ratio, quick assets divided by current liabilities. So the answer should be 1.6 times. So how to calculate the inventory turnover ratio? That's the cost of sales divided by average inventory. So the cost of sales is not provided, but as you can see, the sales value is given and the gross profit margin is also given. So you know the difference behind the sales and the gross profit is cost of sales. So if sales are 600, gross profit should be 25% of it. So that's 150. And then cost of sales should be the difference between the 600 and 150. So that's 450. And average inventory, you have to get the average inventory. So additional information, inventory as at 1st April 2016 was given, it's 180, and the closing inventory was 120. So the average inventory is 150. So your answer should be 450 divided by 150. That's 3 times. So your answer should be answer number 4. If you go to the question number 45, the following information relates to two manufacturing companies for the financial year ending 31st March 2017. Both two companies are RPLC and QPLC, and 4 ratios are provided: debt equity ratio, interest cover ratio, return on equity, quick assets. So based on given information, state the following in relation to these companies. Number 1, the company that then generates a higher return to shareholders. So the shareholders' return should be measured using which form, which ratio? So that's the return on equity. So the equity represents the shareholders' funds now. So the return on equity. So we have to check in which company the ROE percentage is higher. So the answer should be RPLC, as it's 25%, QPLC is 20%. And B, the company that has a higher ability to cover interest expenses. So the interest expenses covering, so what is the formula, what's the ratio? So that's interest cover ratio. So based on the interest cover ratio, RPLC that's 2.5 and QPLC 3.2. So the answer should be Q. C, the company that uses more debt capital to acquire assets. So debt equity ratio. So RPLC, that's 1.5, and QPLC, that's 0.8. So it seems the debt position of the company R is much higher. So that means they are using more debt capital in order to acquire assets. So the answer should be R. And last one, B, the company that is more capable of settling short-term obligations. So that's the quick assets ratio. So based on the quick assets ratio, RPLC is 0.8 to 1 and QPLC is 1.2 to 1. So QPLC will be able to settle their current liabilities using their quick assets more easily. So the answer should be Q. If you check the question number 46, state whether the return on equity ratio and the debt equity ratio of a company as at 31st March 2017 increases, decreases or remain unchanged in each of the following transactions while other factors remain constant. And within brackets, very important, assume that all these transactions took place on 31st March 2017. And there are two transactions. So the first one is obtaining a long-term loan from a bank at 12% interest rate. So you are going to obtain a loan from a bank. For that you have to pay interest. So the first ratio is return on equity ratio. So how do you going to calculate the return on equity ratio? That's the profit after tax divided by total equity. So because of this, your profit after tax is going to be changed because you have to pay interest. And equity, there's no impact over the equity because this is a loan, it should be added to the debts. But when does this transaction take place? So that's at the end of the financial year. So that means you have not paid any single rupee for as interest. So your interest expense is not going to change. So that means your profit after tax is not going to change and your equity is not going to change. So your answer would not be changed. But when it comes to the debt equity ratio, as at the 31st March 2017, you have obtained that loan. So your debt balance goes up. So that means your debt equity ratio is going to be increased. Why? Your debt balance is going up while the equity balance remains unchanged. Part B of that question, making a right issue of shares where all rights were subscribed by existing shareholders. So you are going to issue a right issue. So for what's the double entry for issuing a right issue? So that's cash account debit, ordinary shares credit, right? So there's an impact over the equity. So when it comes to return on equity, profit after tax divided by equity. So there's no any impact over the profit, right? And equity, yes, there's an impact over the equity because your equity balance, that means your ordinary share balance is going to be increased. So the denominator is going to be increased while your numerator is remain unchanged. So your answer should be goes down, right? So it should be the answer should be decreasing. And debt equity ratio, by issuing a right issue, your debt balance would not change, but your equity balance goes up. So debt balance remains unchanged, your equity balance goes up. So numerator remains same, denominator is going to be increased. So your answer should be decreased. Okay, so that's all about the 2017 past paper and accounting for ratios lesson as well. So as you saw, there were 3 MCQ questions and 5 marks question for the second paper as well. So altogether approximately you were able to cover like 10 marks, approximately 10 marks from the 2017 past paper. So when it comes to A-level examination, 10 marks is very significant. So keep in your mind, these ratios will not be provided at the exam, so you have to by heart those things. So just reading on these formulas, you won't be able to by heart those things, so you have to practice, regular practice. So that's all about the lesson. So we will meet with another lesson in another day. So best of luck with your studies. Thank you.